All right, good morning, ladies and gentlemen. Welcome to MACROACE with your host, Tony. I'm also the head financial analyst at FinancialJuice. We've, of course, got some sentiment to have a look at with First Republic and how that's had an effect on the markets already, and then also what to expect for the GDP data and what has happened in the past and what is GDP. So let's work away from what is GDP first. So it represents gross domestic product represents the total dollar amount of all final goods and services, even if it's not on the shelf or if it's in storage and hasn't been sold. And this is at an annualized rate, showing how slow or fast the economy has been growing at. So the differences with the US and other data from other different nations when representing GDP data is GDP is represented on an annualized rate basis, which means they can gauge how fast or slow the economy will be in the upcoming year ahead, which makes it easier to create policy for the government and also for the central bank when looking at creating monetary policy as well, and how they expect the US economy to perform. Good morning. Pataliano says, hey mate. Andy Bleed says, good morning. Good morning to you all. So that's what GDP data is in a nutshell, nice and simple, how slow or fast the economy is growing and is expected to grow. Then the fundamental effects, again, a higher reading of GDP or real GDP improves the standard of living for Americans. However, GDP growth due to inflation erodes living standards because people pay more for the same. So the GDP use, as said, can be used for the White House and the Fed to review how poorly or well their policies are working. The other key point being here is that because you're not including inflation, it gives you a real idea of how the economy is performing. Otherwise, if you have an inflator report, then it's not really representing how well the US economy is truly performing. Has there been an actual increase in productivity, or has there been, or is it just because prices have gone higher and everything's become more expensive, or vice versa? All right. So Slanding says, what if GDP shows less growth but PC is high? Will the Fed still hike? We'll go through that in a little bit. Hold on to your question. I'll get to that in a little bit. So how does it affect the markets? So in a simple way, currency or robust economic activity can firm up interest rates, which increases the demand for the dollar. And we've seen it in the past as well, particularly when we're looking at GDP data. The dollar or the dollar yen has seen the biggest reaction within the currency market and market overall. If we're comparing the size of the move to other asset classes as well, such as stock indexes or bonds and gold. So if inflation accelerates and stays high, it can lower US competitiveness in the world and worsen trade. Of course, you're looking at the quarterly data for the PCE prices today. You're not getting a month-on-month read. That's the only difference with today's read and tomorrow's PCE price index data. For the stock market, usually when there's no tightening that's going on, and a healthy economy generates more business earnings and also adds more confidence that US businesses are doing well. So that will hopefully lead to people or potential investors or investors to jump into those stocks as well. However, the flip side of that as well is that if we do see higher prices creeping through, if you're looking at the non-adjusted data for the GDP data, and if prices are increasing much higher than what businesses or economists are expecting, then that could lead to the Fed maybe taking stronger action to enforce higher rates of interest to try and dampen that down. For the bond market, in a normal environment, whenever the economy is doing well, you would usually see traders jumping into the stock market instead. So what happens is the bond yields will typically rise in a way to attract traders or investors to jump into the bond market with a high yield at a lower price as well. And that goes for the same in a tightening environment as well. When the economy is doing well, the other reason why bond yields go higher if the GDP data is higher than expected is that it's the expectation that the central bank will take stronger action to curtail the strength or the productivity strength within the economy to try and then temper other measures such as inflation or consumer spending as a whole. Lo-Fi Leli says, hello, Tony. Hello to you. So for the bond market, and then the flip side for the bond market we've got to consider is that if you do get worse than expected data, that will lead to, one, the expectation that traders are fearful of what could happen, of the economy maybe not standing up on its own 2 feet that well, or they could lead to a recession if the figures are really bad overall for GDP data. And that, as said, traders would jump into the bond market as a way to, one, make sure that they jump to a bond that they know that they will get their principal amount back and some form of interest. And if there's no yield, if, let's say the yield that somebody gets is flat, at least traders know that they'll get their principal amount back if they jump into government bonds rather than staying in the stock market instead. And what could happen if things are going really downhill, particularly for the US, that could also lead to a negative reaction on the dollar as well, because traders and investors or businesses that use the dollar or are invested or jumping into the dollar might see that the US isn't able to handle if there is a recession, or maybe not able to handle the economy that well, or isn't doing so well, less confidence in the dollar that occurs from that. So they're more likely to see a pullout from the dollar rather than trying to stay in it. That's one of the things just to be that's just one of the things to be aware of as well with GDP data. So the current sentiment at the moment is still, if you do get better than expected data, that will lead to the Fed hiking more or for longer, rather than we're still yet to see a shift from where bad data is also bad for the currency and also for the stock market, and that hasn't shifted just as of yet. So then if we're looking at where the economy is at the moment, so GDP, or the last round we had for Q4, ended up at 2.6% compared to Q3 of 3.2%. Inflation coming down nicely. It was previously at 6% and now 5% in the US. Manufacturing PMI, how strong is the manufacturing sector, at 46.3 compared to 47.7. So a continuation of a downturn, but you're kind of expecting that if the Fed has been raising rates by a significant amount quite quickly, and that demand for those goods or new orders would also decline in expectation from the Fed raising rates. So that means businesses are able to borrow less, or maybe have to pay back more debt, and so they have to shift their focus to more towards their debt that they might need to pay off, or take less loans out instead of buying new goods or getting new services. So industrial production month on month was at 4% compared to 2%. Durable goods orders, so we had this week was at 3.2% compared to the prior month of -1%. Non-farm payrolls, solid amount at 236k compared to 311k. The Michigan Sentiment Survey as well, of course, a key gauge of how consumers are feeling within the US about the US economy, not just about their own financial situation, was at 63.5 compared to 62. Consumer spending, of course, which we get the latest report, the next report tomorrow. It's currently at 2% compared to the prior 1.8%. Retail sales, again, another gauge of consumer spending, which makes quite a big chunk of the GDP report, was at -1% compared to -0.4%. So those the economic indicators that we need to be aware of you've got a bit of a mixed picture. It's not absolutely horrendous whether whether the US's economy is in shambles, but but it isn't also that great. If you're looking at the figure at the top, GDP quarter on quarter, you can see that there is a depreciation, or there is a slowdown in productivity overall for the US economy. And again, that's something to expect with the Fed and the tasks that they've the rate hikes that they have been doing. All right, next thing. So then the Fed views then. So Fed's Powell said on March 22nd that it is too early to say if recent effects change the odds of a soft landing, and that is hard to say if that helped the probability though. So remember, we're talking about the banking turmoil that we had seen in March with SVB, and then having a knock-on effect in Europe as well with Credit Suisse. It was quiet for a long while, which feels a little bit odd, but we'll talk about sentiment and how that's creeped back in today. Or we'll talk about it today with how First Republic creeped back in and kind of shaken up the markets again. Fed's Williams says that GDP will contract slightly this year before rebounding in 2024. Harker, April 20th, said they predicts that GDP will be less than 1% this year. Bowman said the bankers anticipate an economic slowdown within the next year, which means fewer lending opportunities. Mester said the economy is on track for slow growth and it wouldn't take a big shock to generate a recession. Then government views and other views as well. So IMF Managing Director Georgieva says that US tariffs on Chinese goods cut global GDP by 0.4%. That's still something that's a point of contention between the US and China at the moment. Does the US continue with their tariffs that they want to implement on Chinese goods, or do they kind of realize maybe now's not the right time when there could be a potential for, one, a banking crisis, and two, we're yet to see the full effects of the rate hiking cycle from not only in the US but also other central banks too. Remember, we're very interconnected with each other. There's a strong globalization, put in other words. So if one country falters or sees some faltering, then there's going to be a knock-on effect on everyone else. So that's also another thing to be aware of as well when we're looking at the GDP data, and then comparing it to other countries too. Yellen said on April 14th that a soft landing is still possible despite the banking crisis, more or less putting it off and saying everything's okay. There is nothing to see here. If you've seen that, I think it's a Naked Gun, where he's standing out in front of the burning building, and he's saying, "There's nothing to see here. And, move along," and the building's burning behind him. April 15th, Yellen added that bank credit tightening could act as a replacement for more Fed rate hikes. That's also very key too. Now with First Republic, coming back into the fold, do we see tighter credit conditions from the commercial banks? And does that mean that the Federal Reserve in the future needs to do less work, or does that leave May for the upcoming rate hike or the rate decision? Does that mean that the Fed don't go with a 25 base point hike? It all kind of depends on what happens between now and then. If the US government or maybe other commercial banks decide to jump in and say, "Hey, First Republic, we'll help you out with your issues," or maybe they're not helped out, and then it creates another domino effect with this, which the government and then the central bank has to try and clean up the mess again. I.e., do we see a repeat of the 2007 to 2009 financial crisis? The forecast range for GDP data as well, highest estimate according to economists, they're seeing 3.5% to 2.4%. And then investment bank views as well, also very key. So Solomon, back on March 7th, said there is a much greater likelihood of a soft landing for the economy now than there was 6 months ago. JP Morgan, March 16th, said that they approximately estimate slower loan growth by mid-sized banks, which could deduct a half to a full percentage point off the level of US GDP over the next year or two. So that is also another thing to be aware of too. How does GDP play out through the rest of the year? What kind of figures do we get from the second estimate, and then the final data for Q1, and so on for Q2, 3, and then 4. And then the forecast of what these investment banks are looking at for the GDP data. So the current forecast for GDP data, or the median estimate, is 1.9%. Yesterday it was actually at 2%, so it's gone down just a smidge. But you have Deutsche Bank that estimate GDP quarter on quarter to come in at 2.2%. Bank of America see 2%, TD see 2.3%, and JP Morgan see 1.9%. So not really, if you're comparing the deviations from the investment bank's point of view, there isn't too much of a deviation. But of course, the advanced data has always been, and the reason why we're covering it is because it can be quite volatile in regards to the final figure that comes out from the advanced data. So that's going to be quite key to see, have those ranges really, have they factored in everything with regards to the estimates for GDP, or are there going to be other things that kind of surprise in the GDP report that give us a surprise figure? Now, sentiment, as I was saying earlier on, so we had First Republic, hey. So SVB, yeah, that's kind of, the dust had settled on that, and the markets were seeing a bit of an upswing, and we're coming back into the fray. Then Credit Suisse happened, and the markets were in turmoil again. And now we have First Republic. So the US government is currently unwilling to intervene on First Republic. That was CNBC citing sources. Now, what that led to was this reaction in the market. As you can see, so confidence in the dollar, or the dollar index, had tanked. S&P down, and everyone went into gold instead. If you've seen my video about risk on and risk off, this is more or less a repeat of what we'd seen during the 2007 to 09 financial crisis. At the beginning, there's a loss of confidence in the equity market and also the dollar. But when things really start to hit the fan and the government says they're going to print money to save the economy, then there's a bit of, then you see a bit of a reversal, and there's a shift from gold to the dollar again, because cash is king. And there's a finite amount of gold to really keep traders happy enough. So rather, instead, they would go to the dollar. Again, that's another video that I'm hopefully going to do again for this as well. Scotch and Stocks, you're having issues with signing into FinancialJuice. It's not working for you. If you jump onto the pure chat, and then the guys can help you out in the office with that. Should try incognito mode and see what happens. If that doesn't work, then we'll deal with it as best as we can. That will might have to do a Control F5 and see what happens with the site then, if that goes for you. Yeah, so that little bit, if you do Control F5, see what happens. If not, then we'll have a little look from our side. All right, so as I was saying, so that was the reaction from the First Republic headline that had come out. So you can see that there was a loss of confidence in the dollar there, and then in the S&P 500, there was also a loss of confidence there. Gold, you'd seen a movement towards the upside as well. So bearing in mind, so yeah, it doesn't really make sense. If you print more dollars, you lose value in the dollar overall. But it's a sentiment of that the economy can recover, with the US kind of jumping in, and the US government jumping in and saying, hey, with the Fed, and say, hey, let's print money, kind of shore up the economy instead. So there was a noticeable switch from gold to the dollar partway through the 2007 to 2009 financial crisis. Now, if we're looking at the last market reaction for GDP data, this is how it reacted. So you can see that better than expected data. There's a 0.3% deviation on the headline figure itself. So the forecast was 2.6% and it came out at 2.9% for the advanced data back in January, at the beginning of the year, 26th of Jan. So 0.3% deviation. And we'd seen that the dollar had seen a positive reaction. S&P 500 had seen a depreciation. And then also government bond yields had seen an appreciation as well. Now, if we're looking at the current deviations, then we kind of go into detail. What's going to see the biggest move in the market? So if I just bring it up here for you. So what we can see here is that, and this is going to be different for consumer spending tomorrow, but the biggest market reaction has generally come from the currency pairs compared to the stock indexes. So the dollar yen had seen the biggest market reaction out of everyone else, and consistently, if we're looking back to the past, has seen the biggest reaction out of everyone else, barring maybe cable on one occasion, or last year. We can see that last time around we had 65.5 pips pip move towards the upside. On gold, we'd seen 67 ticks towards the downside. Euro dollar seen 24 pips down and after. So what does this? So let me just kind of clarify what you guys are looking at if you're kind of confused or if you've never come across this. So the deviations, what I'm showing you here is how the markets react to the economic release, and by how big of a deviation then causes that certain amount of a move. So this is looking at data on a 1 minute chart. So the initial figure here shows you the reaction on the first candle, going to the wick of the candle to capture the entire move, how big the initial reaction was. Then the figure in the brackets shows you the movement at 10 minutes after the release. Again, still on a 1 minute chart, or looking at all this data, and this goes to the end of the candle. So you've had the initial market reaction move that's been captured, and then this is showing you to 10 minutes after the release, when things kind of calm down sometimes. But that's the standard format that I have here. Now, what I'm showing you here is that on the dollar yen, you had seen 65.5 pips move towards the upside on the initial reaction, going to the wick of the candle. After about 10 minutes of trading from the start of the release, it was up by 14 pips. Okay, so go from the beginning, and 10 minutes later, where did it end up? It was up by 14 pips 10 minutes later. Same thing with all the other currency pairs and assets that I'm looking at as well here. It's the same format, unless, so just to make it clearer for you, so if it says, let's say dollar yen moved 65.5 pips up, and in the brackets it doesn't have up or down, it usually means that it's gone in the same direction. Unless it's gone in a different direction, which is what we've seen here on the S&P, the Dow, and the Nasdaq. So that's what so hopefully that kind of clears up what I'm talking to you guys about here. If it doesn't, do feel free to email me at tony@financialjuice.com, and I can kind of explain in a bit more detail as well. So that is my email here. Don't forget to like the video, subscribe to the channel, share the video as well if you find this content useful so far. So what are we looking at here for ourselves for a market reaction, for deviation? So if we're looking for, so we've got to be mindful of what the big boys are looking at too, right? So if the big boys, let's go back here. Okay, so if the big boys are looking at a range of around high end of around 3.5% to 0.4%, we're looking for quite a big range for ourselves as well. So if you're looking for, if you're there looking for about at least a percent deviation on the high end for the advanced data, that's going to be, we'll be more or less be looking for a percent deviation on our side. But in the past, as I've shown you, we had a 0.3% deviation for the GDP data. That's also something to be aware of. So if we're looking for about at least a 0.5 to a 1% deviation for the GDP data today, then that's something just to be aware of. That's what we're kind of looking for, to see a solid, strong reaction from the market, where you would expect the dollar to, either continually move and kind of stay strong, rather than try to reverse its gains from the initial release of the data. So that's what we have today there. Now, if we're looking at the deviations, so again, deviations for the economic release, that, my dudes and dudesses, that is completely free to have a look at. Okay, so as said, it gives you an indication of how the markets have reacted to an economic release and how big was the deviation to cause that reaction. As said, that's completely free. All you've got to do is sign up to the MACROACE mailing list, and then from there, not only do you get the data for the upcoming economic releases for that week, but you also get a summary of what to expect for the week ahead. It's a short, quick summary. There's no flashy graphs or anything like that. It shows you a summary of Asia session, US and European session, and then a summary of the weekend news, all in one short email, just to kind of temper your expectations, because the detail comes through with me here, explaining to you here in the live streams. So that's what we have for the expectations then for the economic release. We'll see how the markets react. So the other thing, so going back to somebody's question, I've got to find it in the chat now. There's so many questions that have come through, or comments have come through. Let's see. Casadak said PC is more important to the Fed. Fed is focused on inflation, not growth. If markets move, it will be because of jobless claims and PC, not GDP. Cheers. Well, you've got 2 points here. So there are other factors too. Yes, remember the PC data for today is a quarterly representation of PC price inflation. Remember, the Fed's preferred measure of inflation is the core PCE prices for a month-on-month basis, or nearly, of the data that's released monthly, okay, rather than showing quarterly how well what was personal consumption and expenditure price index like for the quarter. That's one distinction to make clear. GDP, yes, that is also important for the Federal Reserve. There is, of course, a focus on inflation, but how well does the US economy perform? If you do get a shocker where it continues to, perform or outdo maybe the forecast, like we had seen with the reaction from the dollar yen last time around, the dollar had moved towards the upside, and the S&P had seen a depreciation from the data that we had initially had. We've got about a minute left to the economic release, so let me get my TICKSTRIKE up and ready. All right, let's see what happens here. Release is ready. All right. Let's have a look at gold. S&P, there we are. Okay. Whoa. Okay, 10 seconds to the data. Let's see, what do we get? Okay, that's the initial jobless claims there. So 230K. 1.1%, 1.1% lower than the forecast of 1.9%. As said, initial jobless claims 230K lower than the forecast of 248K. Core PCE prices advance of 4.9%, 4.9% higher than the forecast of 4.7%. continued jobless claims of 1.858 million, 1.858 million, higher than lower than the forecast of 1.87 million. PC price advance at 4.2% and GDP deflator advance at 4%. So you have worse than expected GDP data, 1.1%. And initial jobless claims was also lower. Core PC prices advance is what we can see at 4.9%, higher than the forecast. So that is also causing the bit of the downside then of what we could initially see there. PC prices advance. Of course, we're waiting for the monthly report for tomorrow, but that's what's moving the S&P 500 so far off of this data here, and also the dollar end towards the upside. Bond prices heading down, so that means the yields are going higher, and this is on the 2-year bond price here. Let's see what else we have. Let's bring up the GDP data. Let's kind of have a little read through it too. So to give whilst I'm kind of reading through this report here, let's have a little measurement. The market reaction. So the dollar yen jumped towards the upside. So this is a mixed bag of data, really. So GDP, okay, got about a 0.9% deviation. Excuse me, 0.8% deviation on the headline figure there itself. The core PC prices advanced. Remember the quarterly data at 4.9%. So if you're comparing it to the prior as well, smashing the prior and coming in higher than expected. So 42 pips towards the upside on the dollar yen. S&P, what do you do here? Okay, S&P about 30 ticks. 30 ticks down. So not a huge reaction. The bigger reaction coming from the currency pair. Let's see what bond prices are doing. 2-year bond futures, they're 40. Let's see what the NQ did as well. It's 131 ticks towards the downside there. Let's get the deviations up and running and see what we had last time around. How big was the reaction on the S&P? So the last time around, when we had GDP data, the S&P had seen 57 ticks down. Today we get 30 ticks down on the initial reaction. And on the NASDAQ, a smaller reaction as well of 131 compared to what we had last time with the advanced data of 186. So, all right, so bad GDP data, but also higher than expected quarterly inflation data as well. If we take a look at GBP/USD, because they have the second largest reaction, currency pair wise. Okay, that's been hit. But again, initial move wasn't as big as last time. Last time we had about 35.5 pips down. Today we get 20 pips towards the downside. Okay, so this is how the market. So as said, markets reacting to PC data. Keeping an eye on that compared to the GDP data itself. So that's got a mixed bag to deal with here. from what I take it as from there. All right. So that is the economic release for there. Yeah. All right. So that's the economic release from us today. We do have consumer spending for. Actually, I want to check gold before I kind of leave you guys, because see what that was like. Let's see how much did it go down. Let's see. All right, 78 ticks down. Last time with gold. So there's a bigger reaction in gold today compared to last time around. It was 67 ticks last time around. Now it's 78 ticks down today. Okay, so as I was saying, with FinancialJuice, where you get if you're looking here where the data had come out, one thing to remember is that if you're a retail trader, right, you might not have come across a live voice and text feed. So usually that is something that the big boys or the big traders have access to. The reason why they use it is because, one, they want to understand what's moving the markets. If it's a headline, okay, that's kind of caused a market reaction. Let's say Fed's Powell has said something to cause the markets to go haywire, or if there is news about First Republic that came out yesterday again, that came out that caused the S&P to go to go down, stuff like that. Understanding what the sentiment is of the markets at the moment. Right, what is the risk that traders face in the markets? So if I can just move this out of the way. So this is FinancialJuice. So again, a live voice and text feed is used by the big boys to manage the risk and capitalize on potential trades. So here we have our live voice feed here. Okay. And at the same time, you have your text headlines coming out that come out as well. And then on the left-hand side, you have your economic calendar with all the data of what to come, what's coming for the day, and also for the rest of the week, but also what's happened earlier on, and the need-to-know market risk. What do you need to know that has potential to cause a risk within the markets, or has already created risk within the markets, or have the markets already reacted to it? Again, that's all in one place, a live voice and text feed, so you can understand what's moving the markets and what the sentiment is of the markets at the moment. That's something that is quite essential and key to have at play with, is to understand that, whatever's going on, okay, you know what the news is, and then it's just down to your own day trading, and if you decide to, and if you can, scalp the markets. So again, this is another tool to add to your arsenal here with FinancialJuice Live. Now, there is the free version of FinancialJuice, okay, which is still useful, but you have a 10-second delay to the site. You have adverts that play. You have ad banners that also appear on the FinancialJuice news feed as well. But if you would like to go to the pro version, all you've got to do, where the pro version has no adverts playing, there are no delays to the voice or text feeds like the live version has, and you also have the access to the news desk to ask us why the market's moving in a certain way. Has there been a headline, or what to expect for the day ahead, such as events, or kind of ask your questions if you do have any issues with the website. That again is all in one place. So that's a pro version of FinancialJuice. Now I would recommend, or if you've never come across the live voice and text service and this is your first time having a look at it, create a free account. See how you find it of using or utilizing a live voice and text service. Does it really work for you? What can you, how can you incorporate the tool into your day trading? This is for day traders, FinancialJuice. Okay, so it's capturing what is happening. What are the things that are happening in the day, as I said, such as First Republic that we reported on yesterday in the markets. So that is FinancialJuice. Oh, got a question. Peak says, is payment with crypto available? If you check with Amar at FinancialJuice, I believe it still is, but I think we'll just have a little double check with Amar here. Okay, right, that is his email there. That you can have a little double check with him, but I believe it is so. Wow, the market's still not having a good day. So you can sign up to, so if you do want to go pro straight away, if you like the product or the service that we have on the from what you've seen so far, then you can click on a button here which says go pro. First of all, make sure you have an account. If you haven't got an account on FinancialJuice, and you need to go to email, verify that, and then go back and then you can pay for the subscription, whatever kind of suits you. Okay, whatever the options are that are presented there. Then once you've paid for the service, then just log out of your account and then log back into FinancialJuice, and then you should see this beautiful website that we have of FinancialJuice all in one place. Okay, again, you have your voice feed, you have your text headlines, you have your economic calendar on the left-hand side here. You have your news desk to ask us questions about what's happening in the markets. And you also have your need to know market risk of what's happened or what could happen, or what to expect, or what could have an effect with sentiment or risk within your trading day. All right. So that is FinancialJuice. I've popped in the link there for you to have a little look at. And then finally, TICKSTRIKE. If you've used TICKSTRIKE before, then you'll understand what it does. But for those of you who are new to the stream here or new to FJ altogether, TICKSTRIKE it allows you to listen to order flow within the markets. Okay, so that's within, or another way to look at it, it shows you how strong or weak, how strong the buying or selling momentum is within the markets. So that's not just in currency pairs. You can also look at futures, stocks, crypto, and your internals like your VIX as well. Okay, that's what TICKSTRIKE covers. Now, what does it look like? So this box here is what we call the ticker, and the ticker box, what it does is, as I said before, it shows you how strong is the buying or selling momentum. The number here shows you how strong it is. That goes from 1 to 15. Okay, and the color or the minus figure shows you the selling side of selling strength, and then the plus symbol shows you the buying side. Now, at the moment, as I was saying, you have this number here. What does that number mean? So the number shows you the level of sensitivity. Okay, 1 is the most sensitive to market reactions. So when there's a little bit of buying or selling that occurs within the markets or the ticker or the asset that you're looking at, as you can see here, then TICKSTRIKE will pop off and give you a visual alert and also an audio alert, which I've kind of got turned off for now. But if you only want to understand when there's a big movement, big buying or selling movement that's happening within the markets, then you can increase that level all the way to 15. 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that occurs will TICKSTRIKE pop off for you with an audio and visual alert. So you can, of course, change the sound or whatever suits you colorwise as well. But that's the use. So again, if you're a day trader, if you're scalping the markets, again, that's another tool to add to your arsenal when trading, when you're trading in your day. Of course, with TICKSTRIKE, that you can kind of chop and change that. It's not restricted to a certain number like it is on the FinancialJuice site, and you're restricted to only 4 different assets. But here on the full version of TICKSTRIKE, you can kind of chop and change whatever you want to look at, more or less, on TICKSTRIKE. So that's TICKSTRIKE there. There's also a 7-day free trial of TICKSTRIKE here, which popped in the chat. Then, if we're looking at some of the other products, then I said, so if you like trading high probability stocks, futures, forex, and crypto breakouts in real time, then you can sign up to Unusual Activity and also sign up for the 7-day free trial of that as well and have a little play with that too. All right, that is the stream then for MACROACE. I was thinking about doing the consumer spending report tomorrow, but historically, there hasn't really been that much of a strong reaction, i.e., where there's been a huge reaction initially from the data, like we see with the CPI data that we've seen in the past. Although that now that's also kind of moderating itself as well. But recently, it hasn't been that strong. The deviations, I have sent that over to those who have subscribed to the MACROACE deviations, to the MACROACE mailing list. Again, if you do want to see the deviations for tomorrow for the for consumer spending, again, if you just email me at tony@financialjuice.com, and then you can have access to the upcoming economic release for tomorrow for yourself as well to have a look at. But we won't be covering tomorrow. I'm going to kind of just gauge what the reactions are going to be like. Of course, the PC price index year on year and the core data is going to be quite important tomorrow to have a look at. But in general, the reaction hasn't really matched up to the level of importance. But it doesn't mean it won't. But I'm just going to kind of keep an eye on it and see what happens. So that more or less concludes the trading for this week with MACROACE. Next week, we're going to have a busy week. That's going to be fun with the Fed and also the ECB interest rate decision as well. So we'll see how that pans out, whether or not markets are still looking at a 25 basis point hike, which there haven't been any headlines to come through with that. So they're still kind of sticking to the expectation for 25 and probably 50 for the ECB when they come out next week. All right, thank you very much for joining the live stream. Don't forget to like the video, subscribe to the channel, and get the word out there if you found the information useful. And I will see you guys next week.